Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on April 11th, 2022. A reminder, trading tomorrow at 11 Eastern Daylight Time. I'm going to review the results from last week. I want to get back to basics a little bit. My emails, questions at webinars, the office hours I did from people who were at Florida IBL either in person or virtually pointed out a couple of things I need to address. And the other thing is, and there are no slides on it, I want to have a little bit of a discussion from the podium about margin. We had a quiet week in terms of new positions, in terms of closing trades. We had a small return on Western Digital, but as you know, in this market, with these market conditions, the first rule of what we do really comes to fore, which is preserve capital. So last week's income, though, we did see a big bump in terms of the cash coming in because of our rolls. As you can see when you go through these, I know I get emails, I want to free up capital, I want to get into new trades. The purpose here is to make money. The purpose here is to generate, I'm going to get to that when I discuss basics. The purpose here is to generate cash returns on the foundational capital of your portfolio. That's the simple part of it. It's not a lesson in creativity. It is a lesson in prudence plus very, very, very aggressive goals for income and cash returns. And last week, we hit that goal. 0.5% a week. I'm glad we got there. We got there through a combination of a new trade that we closed early and the rolls. It's important that you focus on your own goals. Yours may be lower. Yours may be higher. If it's lower, you can adjust strike prices one way. If it's higher, you adjust strike prices another way. But the bottom line is set yourself some goals. The goals for the year then become the goals through time for your trades. And that helps you manage positions much better than if you don't have goals. So overall performance last week was very good. Rates of return were elevated, especially on the roll trades, because we rolled out 2 weeks. If you split that in half, that 1.1%, because the rolls did go out not to this Thursday because it was a short week. I took it out to the following week. It'd still be 0.55%, which is above our target, and certainly above the target for a roll. A roll target is 15 to 18% annualized return. Now, the market itself, it continues to be volatile. And one of the things that's come out, independent of the occasional headline from Ukraine, is the underlying thing is the Fed and interest rates. Big news on the Fed and interest rates moves markets. There's been a slaughter in the bond market, which should have been anticipated by some. And that dovetails with the companies most sensitive probably to interest rate increases, which are the banks. There was an interesting piece, I can never remember, CNBC or Bloomberg or the Financial Times, that the traditional link, and we have seen this, by the way, in a negative way for us, the traditional link between rising interest rates and the banks in terms of expectations and the way bank stocks are being traded was broken and has been broken in this last cycle. Interest rates have been going up, and the banks, based on history, would have gone up. They didn't, they went down. It was a concern about inflation, was a concern about the economy sputtering because of interest rate increases. It's very hard to determine because it's only a short trading history, but we will see a lot more this week in reaction to bank earnings, which start in earnest on the 13th. They get fast and furious on Thursday the 14th. Remember, this is a short week. Markets are closed on Friday. And then one of our positions, Bank of America, announces on Monday. And I think the forecast may be actually more important than the actual earnings themselves. Now, here's this thing about back to basics. I've been hearing that members continue to myopically focus on their portfolio. What did I do this week, Friday at 4 p.m.? And they're not tracking cash. It doesn't mean you shouldn't look at your portfolio at Friday at 4. I don't, by the way. The only important number for me personally is the quarterly performance of my portfolio. But I track cash religiously. And some members are using margin aggressively, and they've been hurt, especially when I recommend accepting shares. I mentioned in the Income Madness week that a couple of people on E-Trade said that they were required to have a margin account with very aggressive 20% margin terms to trade to sell puts. I don't know where that comes from. It's clearly not the law, and it's something that you need to investigate to see what the structure of your account is, what your margin is, whatever. Um, but when you're margined that far out and you have to accept shares, you may not be able to. And that's happened to a couple of people. Gave them some guidance to contact me via email in terms of looking at stocks and seeing where they could roll a put to keep the position as a put intact. And the third thing is some members are frustrated their capital is tied up and they cannot participate as much as they'd like in new trades. Frankly, there's nothing I can do about that. Capital allocation is yours. I'm not closing a trade on a good company that's underwater, which is throwing off 1% a week or 0.8% a week in premium. Remember, the capital that you have, quote unquote, that is tied up, quote unquote, is still performing. It's still throwing off cash, and I don't believe in taking losses and like a stock is going to be dead for 6 or 9 months. Don't believe in taking losses if a company isn't still in very good shape. And I believe trading the familiar provides better returns than trading the new. So to that point, the short-term focus here will continue to be cash and cash over time. Repeat those words, Michael. Over time repairs portfolios getting hit in the short term. It's done so for the last 10 and a half years. If you're relatively new, you don't know me, I can't say you should automatically trust me, but you should trust me. This is history. This is 7 corrections and a crash. Over time, the generation of cash at 20, 25, 30%, sometimes higher rates of return more than compensates for a 10, 11, 12, 13, 14, 15% correction, which may be more than 20% down on an individual position. And accepting shares, for those of you, and that's why I mentioned margin, is integral to success. You should not sell a put unless you're willing to own the shares. You should have an account structured with a capital structure. You can accept those shares, and you should be willing to turn around and sell the best call, and that's described in the training materials. It is intrinsic to what we do. You cannot get 25% a year unless you sell close to the money puts. You can't sell close to the money puts unless you're willing to own the shares. And you can't say you're willing to own the shares and really not be willing to own them. And about accepting shares. You roll puts when there's a 15 to 80% annualized rate of return or better. I've discussed this several times in that you accept a lower rate of return because it's part of an overall strategy of protecting capital by refusing to take losses on good companies and good stocks. And so there are exogenous factors here that you won't see in an alert. You won't even see in a very big way in the training materials. It's part of the 6-figure portfolio coaching program, which is part of Income Masters, which used to be a program on its own. But I'm going to start discussing it more in the live webinars, that there are exogenous factors that come into this service and that come into managing any portfolio. One of them is capital preservation, and capital preservation means thinking longer term and preserving your capital by focusing on the company first, then the stock, and then everything else. And sometimes, based on the charts, based on the market, you roll put simply to buy time. If I think there's a bottom or we're nearing a bottom and I don't want to accept shares, and I know that most of you prefer puts because that's what you sold, I will stay in a position a little bit longer as a put, just simply to buy time. So if you take a look to prove the point, let's look at this week's rolls. We rolled Marvel, Lyft, and Pfizer. So we did those rates of return, 18, 36, and 42%. Marvel was deeper in the money, and that's why the annualized rate of return was lower. Lyft is a higher beta, more speculative stock. That's why that's higher. And Pfizer's a vaccine stock that's had these premiums now for a couple of years. So those are big numbers. And you're saying, no, I want to do something new. Well, if you sell it, that's the capital you have. It's the value of the shares. It's not your original cost basis. So this is a very good use of the real value of the shares. The capital represented in the shares that you own. Sometimes, and I've said this before, I wish stocks didn't have a name and you traded capital block A, capital block B, capital block C. There'd be less emotion. and you'd say, wait a minute, capital block A has been performing well as a temporary downturn. I can do 36% annualized rate of return. I'm going to stick with it. So here's the calculation. The amount of capital to support the sale of a put is, and then you do the rate of return. I'm doing this here a little bit out of my own frustration. I get questions about this. This is all in the training materials, which half of you don't bother to use, and yet the training materials are worth more than a year's subscription. Some person said it's worth 3 years subscription because it's better than the $2,500 they spent on a day trading service. Yes, I'm giving a plug. You're already in here. It's free. It's yours. Go look at it. And so you can see this is the simple math. And the 365 divided by 14 is how Wall Street evaluates a trade. Wall Street trades 7 days a week. Japanese government bonds on Saturday. Israeli markets, I believe, are open on Sunday. Commodity markets are open, I believe, some are open on Sunday, and so forth and so on. So you divide, you have your rate of return, which is 87 divided into 5,400, and then you multiply it by a multiplier that comes from dividing the number of days in the trade into the number of days in a year. So let's take a look at what we did last week. We had a 29% annualized rate of return. 1.1% in a week, and the reason we put 365 divided by 14 is these were 2-week trades. So we had an absolute rate of return of 1.1% from the cash we brought in last week, but we have to be fair, honest, open. These are 2-week trades if they go to expiration. So it's a 29% rate of return when our acceptable rate of return is 15 to 18%. So what are the assumptions driving this? It's the current value of your capital, not what you paid for it, not even your cost basis. And you have to be aware of your cost basis and aware of your net debits, but you also have to track your cash. Please track your cash. And one of the things that was gratifying during office hours was not the old timers, quote unquote, people who've been with me since the inception of the service, 10 years ago, more than 10 years ago, who track cash. It's a couple of new fellows started last summer who are tracking cash, and they're beginning to see what's going on. Their portfolio is down from some of the part of the portfolio where we have some positions that are underwater is down. But every week they're seeing $1,000, $2,000, $3,000 more in cash coming in. They can see what you would call the vector. The vector of the cash, that number is going up. The portfolio part is stabilized, and they can see that eventually there'll be an intersection, and they'll be in the black simply by rolling positions that are underwater that are still good companies. And you have to track 3 things. You're going to track your portfolio. You always have. You need to track cash, of course, and you have to manage the position. You have to track the performance of Bank of America and Marvel and so forth and so on. So it sounds there's a lot more busyness than there really is. It's only a handful of positions, and it's something you really need to do. So over time, as I said, the aggressive generation of cash more than compensates for short-term downturns. Second, if you can't accept shares, you shouldn't sell the put. And that's a conundrum for some of you on margin. And I'll talk about that in a moment. But whatever you do, please do the math. Now, with the segue, do the math. Do the math of your cash, which you may not have been doing. But let's discuss off-book, so to speak, margin. Margin as a way of catching up with us and distorting our returns, not in that's a bad thing, meaning normally we would do 20, 50% margin, maybe we do 30% a year. But the distortion occurs in risk. And when the market sells off, when you have to accept shares, whatever, margin can be like a scythe cutting across all your positions. And in Income Masters, I know people who have leveraged and used margin underneath spreads. And if you're assigned a leg on a spread, bad things happen. It's a cascading effect like dominoes, and it can wipe out significant parts of your portfolio, which has happened to people. So my admonition is understand the margin terms in your account. Understand margin terms when they come to a position, but more importantly, margin is part of the way you allocate capital, and you need to set a rule for yourself that you never break. How much margin am I going to use in my account over the course of a year? Okay, a stock looks hot, let's plow in there, let's use margin, I like this put position. That's not the way to do it. Come up with a number. I'm not recommending what that number is. I don't give that kind of guidance because I don't use margin in my own account. But margin is part of the capital structure of your entire portfolio. And that's what I'd like to leave you with. I will see you tomorrow at trading. This is Michael Schulman.